Welcome to the Corlin Economics Report, a weekly look at financial and political topics relating to asset-based investing. Guests on this program pay no fees to appear, and guests and hosts disclose any equity interest in companies profiled. Now, the Corlin Economics Report.
Hey everyone, welcome in to the weekend edition of the KE Report. Thank you for joining us, and hey, thanks for tuning in throughout the week on our website, podcast, and YouTube channel to keep up to date with the volatile markets, and especially volatile commodities markets that we have been experiencing over the last couple months. First half of this show, we're going to be really jumping around a lot of different sectors, getting our generalist take on things and the direction that a wide range of sectors are going. And in the back half of this show, we're focusing a bit more on the precious metals and even copper sector down into the equities. Kicking off the show with Rick Bensignor, president of Bensignor Investment Strategies, writes the institutional newsletter Supposedly Irrelevant Factors. That's read by some of the most successful hedge funds in the world. On the retail and individual side, check out the In the Know Trader website. I'll post that in the show notes. Rick has 3 products, a monthly report called the 7-11, where he picks no more than 7 of the 11 SPDR ETFs with the goal to beat the S&P, a weekly report called the Tactical Trader Report, and a daily report called the Daily Tip Sheet. That was started more recently. So Rick, thank you for joining us. Let's start off with U.S. equity markets, S&P, NASDAQ. They're right back to all-time highs. Dips are shallow and being bought very quickly. The Dow, though, it's lagging those other 2 markets. What's your take on the markets and, again, the S&P and NASDAQ kind of leading the way?
Well, look, you've got certain names in the S&P and NASDAQ that aren't all in the Dow. And let's take NVIDIA, for instance, which has just started another leg higher over the last week or so, week and a half. And that's not in the Dow. It's not one of the 30 names. And therefore, you're going to see underperformance relative to some of the mega caps that are leading the S&P and the Qs higher. So it's part of it is just the compilation of the different component names. And look, the reality is that other than the evening news, which tells you what the Dow did, Wall Street in general, professional money managers don't care about the Dow. It's not an index that they're benchmarked to. So the Dow stays forefront in the public's mind, mostly because that's what the news reports most days. But the reality is it's really the S&P 500 that is the benchmark, that is what people should be looking at. And despite the fact that the Mag 7 names represent 30% of the entire S&P index, just 7 out of 500 names represent 30%. So it has its own inherent problems, how it's calculated, just like every other index. It is really the one to be paying attention to. So it's not a surprise that the Dow is trailing. It doesn't have the names that is actually pushing the market higher.
Well, Rick, just to that point, when you think about the weighted indexes, they are so skewed to those tech mega cap stocks, the leadership. When you look at underneath the market breadth, like you say, the other 493 companies out of the S&P 500, or when you look at the Russell 2000 and the small caps, or just the market breadth, what other patterns are you seeing under the surface that may be different than the weighted indexes?
Well, look, you've got the Russell, which so many portfolio managers were mega bullish on to start the year. And it's trailed because rates have been higher up until recently. And we'll get to rates, and I'll tell you how and why I turned bullish at 4.6% and said that was the last time you're going to have a chance to buy bonds at that type level for this cycle. But if you think rates are headed lower, despite the fact that today rates have a good pop because of the employment numbers, but if you think in general rates have peaked and they're going lower, then you're probably going to want to have some exposure to Russell 2000 names because lower rates will help that index and it'll play catch up to some degree. Do I think it necessarily is a pair trade that you buy Russell and sell S&P? I can't make that case yet, just simply because NVIDIA and possibly even Apple, which is now for the 3rd time in the mid 190s, it could break out to the upside here. You've got a double bottom and 2 tops in Apple at this level. And now a third time, you've got WWDC early next week. So if Apple surprises with some good news above and beyond whatever people are looking for, you could get another leg up in Apple. And you're not going to want to fight the S&P itself. But for broad-based participation, you probably want to have some Russell exposure in general, especially if you think rates are heading down to 4% or even possibly lower.
Let's talk rates then, because look, the bond market, the 10-year, in all fairness, has been in a way kind of range bound for almost a year now. But fact of the matter is, maybe we did have that peak when the 10-year almost hit 5% again. Plus, on the back end of that, we had some rate cuts out of the Bank of Canada, the ECB, a so-called hawkish rate cut. Fact of the matter is, we're starting to get some rate cuts out of some bigger central banks. Will the U.S. follow suit? Is the market right to start pricing those in?
Well, I don't know if our Fed is going to cut rates this year. I've been in the camp for this entire year that the market had it wrong when they had priced in 7 cuts for 2024 in January. And I said I saw 2 to 3 at best for this year. And then by early spring, I said it could be 1 or none. And I still stick in that camp of 1 or none. In my view, and I called this in real time in April, when the U.S. 10-year got to 4.74%, I told clients, both on the institutional side and for in the no trader clients, the individual investor newsletter that I write, that if you're in the camp that yields are not going to hit 5% this year, then this is where you want to buy bonds. At 4.72 was my level. So they got to 2 bips higher for the intraday high. I called for a 30 basis point decline down to about 4.43. We got that. We dipped 10 bips below that. We then rallied again into late. And you guys saw this because you get my institutional report. I said there'd be one last chance to buy bonds when yields got up to 4.55 to 4.65. And they got to, I think it was 4.64 or 4.63 on the peak a week and a half ago. I personally bought the largest bond position I ever have when we got to that 4.6 level. And again, we're bouncing today from support in the upper 4.2s, but I think we're headed to 4.21 to 4.13 fairly in the near term. We'll see those levels over the summer. And I think rates have peaked for this cycle. And here, I'll give you an interesting tidbit. Give or take a month ago, I met one of my large institutional clients, a fixed income portfolio manager. I took him out to dinner. And rates were, I don't know, a month ago, let's call them 4.5, something like that at the time. And I said to him, I asked him the question, what odds would you assign that the U.S. 10-year gets beneath 4% this year? And he said, 80% chance. And I said, no, I'm talking about what are the odds they get under 4%? And he says, no, Rick, 80% chance. And I was stunned. I really thought he was going to be kind of 10, 20, 25%. Some chance, but not likely. This is a guy who does not trade equities or anything else but bonds. And he runs a $20 billion bond fund. And I was very surprised. But here's a guy who makes his living, knows everything there is to know about the bond market. And it's telling me 80% chance bond yields are going under, the 10-year is going under 4% this year. I was so surprised. And yet it's really helped solidify my view that yields are likely going lower. And what I'm able to do is, as your listeners know and you guys know, is I do something that is said can't be done, which is time the market. So I've put out 2 bond buys this year, one at 4.72% and one at 4.59%. Those are the 2 peaks in yields this year. And I do think that rates are headed lower. I can't see they go crashing under 4% in the next few months. But in simple terms, think about this just for those who understand price movement and the way markets often work. If the peak at 5% last year is going to stay not just a cyclical high, but potentially a secular high for this, let's call it phase. So I'm content in calling it a cyclical high. We went from 5% down to, 3.79, if I remember, was the low in yields at the very end of last year. So that's 121 basis points. If the high we just made at 4.74 is the reaction high, then we have another leg down that I can measure 121 basis points from that high at 4.74. So that gets you down to what? 4.53. I do my math. 3.53. So let's just say in round numbers, I can make a decent case that we're going down to 3.5%. And I'm not sure for the timing, but if I'm right, we're not going to take out the highs that we just saw this year, the April high or the May high, before we end up going as low as roughly 3.5%. That's the camp, and that's the way I'm approaching the market right now. So I would take advantage of a day like today where yields are up sharply and back into somewhat towards the middle of the range that they've been in over the last couple months. I would be buying bonds and taking advantage of bounces in yields. So right now, the 10 years at 4.42 as we record this. Today's intraday high was 4.43. So we're certainly close enough that, and anywhere from here up to about, I'd say 4.52 is the place you again want to be buying bonds for a move down that right now targets 4.21 to 4.13, just in the near term. And then again, the bigger move suggests something like 3.5%.
Well, Rick, just to follow up on that, we've had, and I understand the messages you have there, that you think that bonds are going higher and that the rates could keep pulling back, maybe below 4 all the way down to 3.53. So that's the cycle terms you're looking at. But we've had some guests on the show that have mentioned they think that the bond bubble that went for roughly 4 decades burst in 2020 when rates got all the way down to 0.4%, as people will remember, and that maybe they'll have a decade or two of higher rates, rates higher for possibly a long period of time. What do you think of that argument that the bond bubble burst and that bonds may be under pressure with obviously spikes and drops along the way, but that they may be under pressure for decades?
I think that's probably right. I'm not opposed to that at all. I do think the 40, and I've said it on your show in the past, the 40-year cycle of being bullish bonds is over. And ultimately, you're going to want to play for higher yields, which means bonds deserve a much smaller portion of your overall portfolio. But it's all about time frame and whether or not you're in any way trading. Are you trading short term? Are you trading medium term? Are you investing long term? And where do you make those decisions is all about how you do relative to underlying benchmarks. If you're 60 or 65, 70 years old and you want to have exposure to bonds, I get it. You want to have some mildly reduced exposure to equities, though, despite the fact that equities keep doing well. And for the longer term now, I think bonds will not do well. I can make much better decisions, and I probably will be much more about cleaning out a fair amount. And I'm in that age category. I'm 65. So I'm supposed to be at the point in life where I reduce my equity exposure and I put more into bonds. I get that. But it's about where and when you do it and the timeframes you have in mind. I will probably, whatever bonds I have bought recently, I will probably dump them out near 3.5%, and that's it. I will be very careful about what type of fixed income exposure I have over time and may very well keep them much shorter term in duration. I'm a big fan. Now that you actually get yield from the U.S. government, which last many years you've gotten virtually nothing, now that you're actually getting some yield, I don't mind using treasurydirect.gov, that website, which lets you buy directly from the U.S. Treasury. Any person can do it in as little as, I think, $1,000 increments, and you can buy 3-month T-bills and 6-month and 1 year. And you can buy notes, treasury notes starting past 1 year, and so on. If we get down to 3.5, I'm more in the camp that I want to keep my money short term, and I don't want to be owning long-term paper at that point, because I'm in agreement with some of your other guests who think the cycle is done, and we're talking about the 40-year big cycle is done, and yields will probably find some equilibrium point higher than even where they are now over time. I just think in the next 6 months or more, it's possible it happens by years, and I'm not sure. I don't think we get to 3.5 in 2024. When we get down there, then I walk away from that whole idea of owning bonds for the long term, and I go shorter term in duration for what I want to have as guaranteed money. I stay liquid, and if depending upon the yield curve, the short end of the yield curve, it gives you more than the long end anyway. You have an inverted yield curve. So there's a lot to be said about taking advantage of that inverted yield curve when I think this bond rally will end somewhere, at least minimally, in that 3.5% range.
Okay. Hey, Rick, portfolio management from a trader's perspective too, right? Not just getting all in on one side of the trade and just letting it run forever. You're seeing an opportunity in the bond market in terms of yields going a bit lower. Let's carry it over to commodities, because boy, oh boy, have commodities sure been volatile. Precious metals have been volatile. Silver especially. Copper went up in May to an all-time high and then immediately reversed. Let's start with the precious metals. Gold and silver's volatility right around that key $30 level. How are you viewing silver?
So it's funny. I put out a buy in silver for today when I wrote the daily tip sheet last night, but it was caveated that should we have a large gap up or large gap down this morning because of the employment numbers coming out, I wasn't going to put the trade on. And certainly with how silver is trading today, it's down significantly. Gold's down $61 right now. It's getting mushed. I think for the bigger picture, I'm still a net buyer of precious metals on pullbacks. Now, recently I sold half of my GLD. I have different ways I own gold, both in GLD, the largest ETF that tracks the price of gold bullion, but I also own GDX, which are the miners, and I own actual individual mining names. As far as GLD itself, I sold out of half my GLD at 222 and change a few weeks ago. And actually, I'm buying some of that back today. Let's see, where's the low got down to 213 today. And I know I had a bid in the 213 level to buy back half of what I had sold at 222. So near term, I don't mind playing. I've held gold for years, but I had a real good reason to sell GLD up near the test of the highs, which was, in hindsight now, a good sale, and buying some of it back now. And the other half, I'll have to look to see where I bid for the other ones. I do want to own gold and silver for the long term. Silver I've had in my portfolio for years. It's been a non-performer for a long time, actually a loser for a long time. I think I bought it in 2011. So it has not helped me at all over that time. And I've seen far more drawdown in it than I have had profits, but now it's finally profitable. So if I remember correctly, my SLV position is long somewhere in the 24 handle. So it's still making money now. You get a day like today where it's really getting rocked, and never happy to see a big loss like this on any single day. 5% losses, almost 6% down today. Not a good thing, but in the bigger picture, I do like the metals. And the reason, besides the fundamentals of the metals themselves and why I'm bullish, is I think the dollar is going to fall right now, and for months already, we're in the phase where the dollar has generally been moving in tandem with U.S. rates. And because I think rates are headed lower, I think the dollar's likely headed lower over time also. in this mini cycle. And therefore, the dollar weakness that I think is coming in the next 6 months will likely be a boost for the precious metals too. So I'm a fan of them. I don't think silver's going back to test all-time highs of $50, not a chance, or at least no reason I can come up with why it would do that now. But in general, I think you want to take a look at the precious metals and find places to be buyers of them. And shameless plug here, this is something we look at all the time. In the weekly Tactical Trader Report, every week I'm always updating everybody about my opinion on bond rates in the dollar, gold, and oil. Those are just, besides the S&P, those are just standard. So if you like the perspective I bring, there's a report that comes out weekly that'll always keep you in the loop of what's going on in the metals markets and where positions on.
Rick, I appreciate you weighing in on the precious metals, how you're looking at it, how you're playing it. And I would like to ask you about one more metal, and that's copper. Dr. Copper is seen as the health of the economy. It had a wild ride higher in May and actually made a new all-time high, was up around $5.20 a pound. Never seen that level before, but it immediately reversed. So some are pointing to that being just a short squeeze, but there are a lot of fundamental drivers in copper, such as China, electrification of the world, all the AI data centers that are going to be needed, EV charging stations. So it's a topical metal. A lot of our listeners look at copper and copper stocks. How are you seeing the red metal?
So right now, copper is trading about $4.50 using U.S. COMEX copper pricing, not London metal. And I'd say, so 2 weeks ago, I wrote about looking for traders to short copper. It made a new cyclical high above the February 22 highs, only to fail instantly. But I think if you're looking to be a buyer and you're talking about some of these fundamental reasons that you think copper may go up, then a pullback to what was a cyclical high, which was January of 23, that's about $4.35. And I've got something else down at $4.25. So there you go. I've got about a 10-cent range between $4.35 and $4.25 that you look to buy the metal itself. If you're looking to buy copper-related names, then I would probably buy those close to when this hits those targets I'm talking about. So with it trading at 4.5 now, you talk about another, 4% to 6% lower, something like that is where I would nibble. And in doing that, you're going to break the uptrend line that you have off of this year's bottom. And that's actually, I don't mind buying broken trend lines because those who are leaning against them tend to get stopped out, and I'll buy when others are like weak-handed longs or puking out. So that's my general range for now, 4.35 to 4.25 basis COMEX copper.
All right. That's pretty straightforward there. So still maybe a little bit of weakness, but boy, oh boy, May was sure a wild month for copper. What about Bitcoin too, Rick? Bitcoin is back right around some of those all-time highs, right around that 71,000 level, just under that today. Bitcoin's always volatile, so we can just leave that for what it is. But in terms of Bitcoin and the potential price moves, what are you seeing?
Well, right now we actually have a bullish Bitcoin position on from the daily tip sheet. We got in, I don't remember, a week and a half ago, something like that, right after it had bounced on some support at 68,000 or so. So we bought, I put out a buy recommendation in IBIT, which is now the most commonly traded ETF for Bitcoin. It's the most liquid, and I'm certainly going to want to be in a liquid one for that. So we've actually hit a near-term target at, let's see what this price is, 72,330 basis Bitcoin futures themselves. And I look at Bitcoin futures as my proxy for Bitcoin. But if we get a couple closes above, and then we can build a base on top of that 73,000 number, then you're talking about 78 to 80,000 as next target on the upside. So that would be new all-time highs. This is something I only would trade. I have a very small position in Bitcoin that I bought, a few years back, but I don't use this as an investment vehicle. Some people do, but I don't like being in investments that regularly move 20 to 50% up and down like nothing. So I still put this in the camp of a highly speculative type of thing to play. And despite those who think they really understand the fundamentals and that you keep having a dwindling amount of Bitcoin available, which I understand that thinking and why Bitcoin needs to increase in value over time, it's just not something that I'm willing to put any substantial amount of money in. So I'll trade it, but it hasn't gotten to me doesn't have the reputation of a type of investment vehicle that I want to deal with, because you got to watch it all the time. And I don't want to have to do that with long-term investments. Your long-term investments should not be regularly moving 20, 30, 40, 50% up and down a couple times a year.
Yeah, fair enough. That's Bitcoin, though, for you. That's cryptocurrencies. That's why some people like to trade them, but it's just interesting to see those, or Bitcoin at least, also back to close to those all-time highs. Rick, we'll wrap it up here, though. Very interesting comments. I really appreciate you sharing your trading strategy with us. Again, it's just taking a look at some of these charts, playing the swings that you see, and quite frankly, on this show, you have been playing these swings very well. I do appreciate all of the insights you have provided with us pretty much on a monthly basis. So, Rick, thank you for your time on this weekend show. I hope you have a great rest of June, and we'll chat again in July.
Thanks, guys. Thanks for having me.
Al Corlin's firm, A.B. Corlin and Associates Incorporated, provides consulting services to public companies on matters of regulatory compliance. To find out more, follow the link from www.kereport.com. The Corlin Economics Report will be back after this brief timeout. Providing unique reporting on markets and companies since 1990. This is the Corlin Economics Report.
All right, welcome back. Continuing to listen to the weekend edition of the KE Report. And as promised, we're shifting our focus almost exclusively here to the precious metals sector, but we're also going to touch on copper and even more so drive down into the underlying equities. We are chatting with Dave Erfle, founder and editor of the Junior Miner Junkie. Now, Dave, just a quick comment regarding the precious metals prices, gold and silver. It's been interesting in the sense that silver especially has been much more volatile, but just over this last 3-month rally that we have had, the corrections have been quite shallow and bought back almost immediately. This week, it was another very interesting week for silver as it dropped just below that 30 level after 3 days almost in a row of some pretty substantial sell-off. But then it's bought back very quickly. We're recording this on Thursday, and Thursday's looking like it's going to be a very good day for silver, and silver's back above $31. So, Dave, your takeaway from, again, the corrections in gold and silver being shallow and bought back very quickly.
Yeah, I mean, it's typical bull market, precious metals bull market action, right? I mean, we're only 8 weeks removed from a major breakout in the gold price above multi-year resistance at 2,000, 2,100. I mean, 2,000 was basically 13-year resistance and a major breakout above there. We had a monthly, quarterly close above 2,100 in March, and then we had a scalding breakout move, and the gold price is just correcting in time and price here. It's moving sideways and doing what it does in a bull market. It came back down and tested. It's sharply rising now, a 50-day moving average, and it's consolidating here below 2,400. We had 2 tests of 2450 and it got a little overheated, and now it's correcting that move. And that's typical bull market action. And silver broke out above 30 on a monthly closing basis last week. And then as soon as it did, we had a sharp reversal, came back down and tested that 30 level this week and went a little below it, like you said, and it's going right back up again. And silver remains in a strong uptrend. So this is typical bull market action.
Yeah, Dave, it's been exciting to see the pullbacks being more shallow and that the buying has come back in silver, and gold has really just held its own. It hasn't been falling out of bed or breaking out. It's just been consolidating the big move it had. I had shared with you just off mic before we started recording that I ran into a couple buddies and they were asking how gold and silver were doing. I reported back that gold's in the 23 to 2,400 range and that silver finally broke 30. And their response was, well, boy, I bet the mining stocks are just tearing higher then. I bet you guys are making buku amounts of money. And that's not what we're seeing. I had to tell them that, hey, unfortunately, the volume's still not there. And while they've gotten off their bottoms, we're just not seeing a ton of love in the gold and silver mining stocks. What would you say to people looking at this dichotomy between the price of the metals and the mining stocks still dragging butt here, even though the prices are very robust?
Yeah, it's an opportunity. We are starting to see bifurcation in a lot of the better juniors and especially the majors and royalty companies. But if you take a look at the volume, it's still just a little more than half of what the volume was pre-COVID in GDX and GDXJ. So there's just still not a lot of interest in gold stocks, and that also in the West, in Europe and the US in gold ETFs. The gold ETF buying has been pretty robust in Asia, especially in China. But here, you're just continuing to see some outflows. But a lot of that is going into physical gold. Costco can't keep gold on the shelves, physical gold on the shelves, and the premiums are high, especially in China. The premiums are really high. I know the premiums got up to 15% in silver in Shanghai. It's interesting that the gold stocks still are lagging, but I think that's about to change. We got about a little less than a month now in the quarter. And at the end of July, these mining companies are be coming out with Q2 results. And in Q1, we already had some blowout quarters from number one and number two miners, Newmont and Agnico, and their share prices followed suit with nice moves higher. But the gold price was averaging a little under $2,100 an ounce in Q1. And it looks like to me at the end of the quarter here in 3 weeks, that the gold price is going to average over $2,300. And that's over $300, probably going to be almost $300 more. So these margins are going to be fantastic. These cash flows are going to be fantastic for these miners.
So Dave, again, that helps the miners, right? And the miners, they have rebounded. The mid-tiers have really been the standout. And as you said, large royalty companies have, but that money hasn't gone down to the juniors. So are we depending on the majors and on the mid-tiers to them filter that money down, or will investors finally trickle down there?
Yeah, I believe they will, but it's still a stock picker's market. We have seen several juniors bifurcate and start to move higher. Some of them have doubled and tripled off their lows. But as a sector, yes, a lot of the juniors are still lagging and the volume just isn't there. They're pretty much really still under-owned, unloved, and even hated by the general public. And like Chad referenced, they're not even looking at them. They're still in AI and crypto. So that's where the opportunity lies. You just have to have a lot of patience, and it gives you the opportunity to buy the best of the best and hold them. I recently added some money to my investment capital to my portfolio for the first time in quite a long time. I've always stuck to the same amount of investment capital since way back in 2005 when I did something crazy and sold my house and put all the money into juniors. And I hadn't added investment capital up until this week. And I just looked at some of these juniors that I own and on my watch list and said to myself, hey, this is the time to get into one more and add to a couple existing positions, because it sure looks to me like the gold price is getting ready to move on to its next target. It's consolidating here below between 2,450 and 2,300. And I think it's just getting ready to go higher. I mean, we're seeing stagflationary, recessionary data coming out of the US. The Q1 GDP is 1.3% and inflation is still 3.5%. That's stagflation. And now we've got weak jobs numbers coming in this week. And it's culminating in the NFP that's going to, in the non-farm payrolls report in the US, it's going to be announced tomorrow. And if that's a bad number, we had a bad ADP number. We had jobless claims rise already this week. So if we have a bad NFP number, I think that could get the gold price above 2,400. And we've also had central banks now lowering interest rates. Canada this week became the first G7 central bank to lower interest rates. And that was followed today by the ECB cutting interest rates for the first time. And that puts pressure on the Fed to do the same thing. And they're eventually going to probably have to lower rates while the inflation rate's nowhere near their fantasy 2% target. And once the market realizes, that's when gold and silver really go ballistic.
Well, Dave, I think the fact that you added capital to your trading account to take more positions or add to existing positions is very significant, especially if you haven't done that since back in 2005. I mean, that is a pretty big statement from you. You don't have to name the companies because those are for your subscribers, but just in general, what are the attributes of the companies you're adding to? What are the kind of companies they are, the stage, and then also what attributes do those companies have that you think give them extra torque?
Well, the new position is an optionality play. They have a lot of gold in the ground and it's trading at less than $10 an ounce. It's in a safe jurisdiction. They have strategic partners with access to capital. They're cashed up well into next year, and they've got a credible timeline for their two projects, one being fully permitted and shovel ready by mid to late 2026, and the other one being fully permitted and shovel ready by mid to late 2027. And they've also got a US Amex listing and a tight share structure. So all that adds up to, once the retail public finally starts to sniff around these gold stocks, these juniors, getting into, a lot of them have retirement accounts or they have Robinhood accounts, and they're not able to get into OTC listed companies via those platforms. So a junior with a big board listing has a big advantage.
Dave, what about other optionality plays? These companies that have been around for a while, they have ounces in the ground, but they need higher prices. If you see higher prices on the horizon, are these some of the low-hanging fruit because they don't need to spend the money and do the work to build up those ounces?
Absolutely. They just need to do the work to attract a partner, a strategic partner, if they haven't attracted one. And they've also got to show that clear timeline to being shovel ready. Because a lot of these North American juniors, these juniors that have these multi-million ounce high margin projects with a gold price above $2,500, their timelines to being shovel ready are pretty far out there, because it takes so long to get a project fully permitted in a lot of these North American jurisdictions.
Well, Dave, I know that in addition to some of the advanced explorers and developers that have ounces in the ground and that optionality, you also have some growth-oriented producers, gold and silver producers that are junior producers. Maybe speak to the optionality there, because if we do see rising metals prices, that has a big effect on their margins, but they also are still exploring. So maybe speak to that angle of your investment strategy.
Yes, that's what I like about these small cap growth oriented producers, because they're working on growth through the drill bit. They're proving up ounces and adding more ounces. And they're also not getting the value for the ounces they already have in the ground. And they have a low debt load or no debt and lots of cash to do this. That's even better.
Dave, what about exploration plays then? We have to ask you, it's gotten more expensive to explore, and we keep on hearing just how hard it is to find new discoveries. The sector hasn't had a major discovery here that has really driven the market and driven interest and driven a takeover since, I guess we would have to go back. Well, Snowline. Snowline's a recent one that has gotten some attention, but that hasn't been taken out. So what about discovery plays? What about exploration plays? Anything entice you there?
Not really. I've ignored them for the past 2 years. Sure, I missed something like a Snowline and a newfound gold, but those are only two examples I could see that produced outsized multi-bagger gains. And I think also moves like that in just two stocks can be detrimental to the sector when the rest of the early stage exploration sector is not participating, because investors see that and they see and they say, okay, well, I'm going to start getting into these early exploration plays because look what I can achieve. I can get these multi-bagger gains in a short amount of time. But when they don't materialize, they end up losing much more money than they expected to make after a major discovery. Because there's still been several of these companies that have had bonanza grade discoveries, major discoveries, and they didn't move nearly as much or even sold off because the market took a look at their cash and said that, hey, I'm not going to invest in this company now. They've only got 4, 5, 6 months of cash left. I'm going to wait till they raise money and get a free warrant. And on top of that, if I'm an underwriter and I know they're getting ready to announce a financing, I'm going to short the stock. So all these games are still being played on Bay Street and Howe Street because this sector is basically being traded by sector professionals, and the retail market isn't coming in, basically meaning that you're not having uneducated and newbie money coming in to the sector when they see a strong drill result in a company and moving the share price up. So what's happening is the street is controlling the price on a lot of these early stage companies. Even when they have good results and investors get frustrated, they sell the stock. The stock continues to go lower while the gold price is going higher, which makes it even more frustrating. So I really don't see the need to take a chance on these higher risk early stage companies just yet, when there's so many of these other companies that have proved up these multi-million ounces in safe jurisdictions inside of high margin projects that are trading at less than $40 an ounce in the ground. I mean, if you take a look at what happened during the last bull market that ended in 2011, several of these companies were being taken out at $1,000 an ounce in the ground and higher. And yet we've got a lot of these companies that the economics of their project look so much better, yet the stocks are trading at less than $40 an ounce in the ground just after the gold prices has broken out and moved into a major bull market and hasn't gotten on the radar of the generalist investor yet. But eventually it will. If the gold price continues to go higher, it can't be ignored forever.
Yeah, Dave, you raised some interesting points, and I think it brings up an interesting topic I'd like to get you to weigh in on, and that is that I've been in the space about 15 years. When I look at it, I think a lot of people are playing the sector, gold and silver stocks, thinking they're investing in gold and silver, but they're in exploration plays that are discovery plays that don't have any gold or silver yet, and they're swinging for the fences trying to get those 10-bagger returns. All we hear about is those 10-baggers, and sometimes the company provides even more than that. But the truth is, the honest truth is that there's 1,000 explorers and 90% of them will never come anywhere close to that. So what that means is they're not going to swing for the fences and get that 10-bagger every time. They're going to strike out most of the time. You kind of take a different approach in your portfolio. You're trying to get 3x to 4x to 5x moved in companies that are a little more established, maybe speak to maybe a little more sane approach to investing and still plenty of upside, but not always trying to get the grand slam, just trying to get some base hits and honest gains.
Yeah, I mean, you don't go for the grand slams till the retail market comes back into the sector. I mean, they left in 2013 and have not returned. That's a long time to be out of this sector. And it's the volumes that are telling you this. The volume has dried up in a lot of these juniors and it just isn't there. And that's telling you that the sector continues to be ignored by the generalist investor. So absolutely, I'm basically putting my major hat on now. I have been for the past few years. If I'm a major mining company, I have to start replacing my ounces. You know, I've shored up my balance sheet. I've got a healthy balance sheet. I'm paying dividends. I'm even buying back some shares because my share price is a little low. Or maybe I'm a major that is bifurcated from the market and my share price is really high. And now I need to concentrate on adding more ounces. So I'm going to I'd like to do so with my high share price and take something out with my shares. So I'm saying to myself, okay, if I'm a major, I'm looking for companies that I think are strong takeover targets in the near to intermediate term. And they're still trading at these rock bottom prices in relation to the price of gold. But they have these attributes, like I said, of basically having a strategic partner and preferably strategic partners, access to capital, that they have enough cash for the next year or so, or they're searching for either a strategic partner or they're searching for an attractive finance package. And they've got all these attributes in their project where they're in a safe jurisdiction. And it looks like they've got this credible timeline to being shovel ready, to being in production within the next 12 to 24 months. Those are the companies that look attractive to me right now because the risk is pretty much taken out of these stocks right now at the valuations they're trading at in a gold bull market. But the risk is still there if you're going for an early stage company that is looking for something, or maybe they haven't reached the PEA stage yet. They've got a lot of shares out and they don't have the treasury to last them for the next 12 months. They're going to be needing to raise money and the street knows this. Then you have to deal with other market forces. Now, with a lot of these early stage companies, and like you said, 85 and 90% of them are pretty much worthless. So there's really no need to take that higher risk in going for these early stage companies right now until we get into a bull market in the mining shares as well as gold and silver.
Yeah, that's the key thing, right? A lot of these stocks haven't moved. So why go down to the smallest stocks right now? Because, well, you can still get those gains in the more established stocks and the stocks that have already done their work. Fair enough. That makes total sense. And again, it just ties into that bigger theme that these stocks are broadly still kind of lagging these breakouts in the underlying metals. What about copper? Is it the same story that you're seeing in copper, where copper went over $5? It did quickly correct to back under $5, but it's sitting around $4.70. That's a generally strong price historically, maybe not inflation adjusted, but historically it is a strong price. Copper majors have done well. The juniors, even the mid-tiers, they haven't done that great. So same story for the copper stocks as the precious metal stocks?
Yeah, pretty much. I mean, $5 is the resistance, like 2,100 was the major resistance for gold. It ran up there. We had a short squeeze. The short squeeze has come off. And I'm seeing stories now that China's got these major stockpiles. They've got a lot of copper piled up, and it looks like the U.S. is heading into recession. But as long as the copper price stays above $4, I think that bodes well for the copper majors and the mid-tiers. But yeah, like you said, I mean, we still haven't seen that come down to these copper juniors yet. I mean, there's several of them that have these huge deposits in really attractive jurisdictions, and they still haven't really moved much.
Would you kind of take the same philosophy then with those kind of companies that have the potential of attracting a major or a strategic partner, or maybe they already have a partner or partners? Would you take that same philosophy that you had with the gold and silver stocks for people that are thinking about dipping their toe into the copper stocks while they're depressed? You know, would you look at the developers that would be attractive takeover candidates?
Yes, and I am doing that. I have one-on-one meetings scheduled with a couple next week that I really like. I wouldn't get into them just yet, but I'm basically putting my ducks in a row to possibly get into one or two copper developers before the end of the year. I'm looking forward to the Beaver Creek conference here in September, and I'll be speaking to a lot more one-on-one.
All right, Dave, we'll wrap it up here. Look, there's opportunities out there, especially in this environment where if you do agree to that gold price could be moving up to $3,000. Silver, who knows where that could go, but a lot of people are saying it could go to $50. It might not go this month, but hey, there's even been some of the bulls out there saying it could go this month. These stocks you think would eventually play some more catch up here. It all starts with the larger cap stocks, and they have started to move, especially in copper. Those have done very well, but I know a lot of us still just sitting there looking at some of these other stocks, the smaller ones. And as you even said, some of these optionality plays, they could really get moving as long as these metal prices keep going in the direction that they have been. Dave, thank you so much for your time on this weekend show. Everyone, thanks for tuning into this weekend show. Please be sure to go back through our website, podcast, and YouTube channel to listen to all the daily editorials and company updates we recorded throughout the week. Dave, everyone listening, I hope you all have a great rest of your weekend.